You know that feeling when you're looking at a company's finances and it feels like you need a secret decoder ring just to make sense of it all? Well, in the next few minutes, we're going to give you one. We're going to turn those complex numbers into simple, powerful insights. Let's dive in. Right. Financial statements. For a lot of people, they look just like this. A massive, intimidating wall of data. You've got rows and columns of figures that are supposed to mean something important. But what exactly? So, have you ever just stared at a balance sheet or an income statement and felt completely and utterly lost? Trust me, you are not alone. It's a super common feeling, but thankfully, there's a powerful tool designed to bring some much-needed clarity to all that chaos. And that tool is accounting ratios. Seriously, think of them as your financial decoder ring. They're specifically designed to help you find simple answers in what looks like a sea of numbers. And this is the core idea right here. Ratios take that big, overwhelming wall of data on the left, and they transform it into something simple, direct, and actually useful. It's all about making that journey from confusion to clarity. So what exactly is a ratio when we get down to it? Well, it's just a mathematical number that shows the relationship between two different figures you pull from those financial statements. That's it. We're not adding any new information, we're just creating meaningful connections between the numbers that are already sitting right there. Honestly, the best way to think about ratios is like a financial health checkup for a business. They are the vital signs, the heartbeat, the blood pressure, that tell you how a company is really doing underneath the surface. And by performing this health check, we get a much, much deeper understanding of a company's performance. We can suddenly see its strengths and, maybe more importantly, its weaknesses. So why even bother with all this? Well, because ratios help you pinpoint the exact areas that need more attention. They simplify these massive, complex figures into something you can actually wrap your head around. They let you easily compare one company to another or even a company against its own past performance. And they can even give you a little glimpse into what might happen in the future. Now, ratios usually get grouped into four main buckets. You've got liquidity ratios, which look at short-term health. Then there's solvency for long-term stability. Activity ratios measure how efficient the operations are. And finally, profitability ratios, well, the name kind of gives that one away. They measure earning performance. To keep things practical today, we're going to zoom in on that first one, liquidity ratios. Okay, that's enough theory. The best way to really understand ratios is to see them in action. So let's put one to work with a real-world kind of example. So our focus is liquidity ratios, and what they do is answer a very, very important and immediate question. If all the company's bills came due today, could it actually pay them? It's all about short-term survival. The most famous liquidity ratio is probably the current ratio. And the formula? Super simple. You just take the company's current assets, that stuff it owns that can be turned into cash within a year, and you divide it by its current liabilities. Those are the bills it has to pay within a year. Okay, let's grab some numbers from a simplified balance sheet. As you can see here, the total current assets add up to $1,34,000, and the total current liabilities are $1,04,000. Those are the only two numbers we need for our formula. So we divide $1,34,000 by $104,000, and we get 1.29. But what does that actually mean? It means for every 1 rupee of debt this company owes in the short term, it has 1 rupee and 29 paise in short-term assets to cover it. That little extra bit, that's its safety margin. But hang on a second. A pretty big chunk of those assets is inventory, right? What if the company can't sell all that stuff quickly to pay its bills? For that scenario, we need a stricter, more demanding test. And for that, we have the quick ratio. It's also called the acid test ratio. I love that name. It just shows you how serious this test is. This ratio basically asks, what happens if we completely ignore the assets that are hardest to turn into cash, like all that inventory? The formula is pretty similar. We just subtract inventories from the top number before we divide. So, for our example company, we take out the inventory from the assets. We're left with $80,000. We divide that by the $1,04,000 of liabilities, and we get a ratio of 0.77 to 1. This means for every rupee of immediate debt, there's only about 77 pesos of easily accessible cash. Generally, a 1-to-1 ratio here is seen as a safe bet. So this number? It would definitely be a red flag, something worth investigating a lot more. All right, now before you run off and start analyzing every company you can think of, there is a really crucial piece of context we need to add. This is important. This quote from the source material really says it all perfectly. Ratios are tools. They're indicators.
They are the start of asking deeper questions, not the final answer.
And you know what? They have limitations. Ratios can't tell you a thing about the quality of a company's management team. They're based on data from the past, which, as we all know, is no guarantee of the future. And different companies can use slightly different accounting rules, which can make those side-by-side comparisons a little tricky. Context is absolutely everything.
So even with those limitations, you've just unlocked a really powerful new way of looking at a business. You've learned how to look past just the surface-level numbers and see what's really going on. With just a couple of simple calculations, you've literally gone from being a passive observer to an active analyst. You can now ask smarter questions and spot potential red flags that other people might miss. And in the world of business, believe me, that's a superpower.
And that leaves us with one final and kind of exciting question. Now that you have this tool, this new way of decoding a business's health, what's the first company you're going to analyze?